Hi, I am Maite, and this is Stock Market Investing 101, Part 3. In this video, I will explain the different ways in which you can tell which stocks will be most beneficial for your specific financial situation. The most important thing to consider while choosing stocks is the amount of risk you are willing to undergo while investing. Generally speaking, stocks that might have very large returns are also very risky. This makes sense because if a company promises great growth with no risk, everyone would buy the stock and the stock price would be very high. As an example, let's imagine a company called Bright Spark Labs that is investigating a solution for Alzheimer's disease. If they find it, the stock price will skyrocket because they will have a unique and very useful product. But if they don't find this cure, the company will go bankrupt and the price will fall. This is an example of a risky investment that has a lot of potential for growth. Let's see the example of Coca-Cola stock. This company is already large, so it will probably not have as rapid of a growth as Bright Spark Labs if they find the cure for Alzheimer's. But unlike Bright Sparks, Coca-Cola has been selling their product for years and is successful in hundreds of countries. Therefore, the chances of Coca-Cola going bankrupt are very low. Coca-Cola stock is an example of a slowly growing stock that carries very little risk for its investors. Stock market prices are correlated to investor sentiment. When investors are fearful of the future of a company, they tend to sell that stock. And when investors see an extremely promising company, they become greedy and want to buy it, even sometimes ignoring the risk that investing in that company carries. Understanding investing sentiment is very important while picking stocks. Excessive greed tends to turn into fear when stock prices are way too elevated, and this causes stocks to plummet. This is why investors should be wary of stocks that have skyrocketed in value without much underlying company growth. This might be an indicator that excessive greed has elevated the price of the stock, but it will soon plummet when this greed turns into fear. When an investor sees that a stock has fallen in price excessively, considering that the company has been relatively successful, he might identify that investors are being too fearful about the stock. If the fear that investors have about the stock wears off, the stock price should go up to match the success of the company. This means that stock prices that have been treated too harshly by fear are less risky, and stocks where investors have acted with greed are more risky because their prices are inflated by this sentiment. And if this greed turns into fear, the stock will fall drastically. Investors use graphs in order to read a stock's price. In my opinion, the best place to find these graphs for free is Yahoo Finance. This is the Yahoo Finance website. Here you can browse financial news, or you can browse a variety of companies that could potentially be some of your investments. For example, you can go here to trending tickers and see a few of the companies that are trending right now. If you want to look for a specific company to investigate its financial data, you can write here in the search bar the company that you are trying to investigate. For example, I'm going to write Amazon, which is one of the most popular stocks in the current market. Once you click the stock, this will appear and a graph will automatically be shown right here. This graph shows the price of Amazon stock along a certain time range, which you can choose right here. You can choose 1 day, 5 days, a month, 6 months, year to date, which is from the beginning of the year until now, 1 year, 5 years, or the max amount of time that Yahoo Finance can show. As an example, I'm going to choose 1 year. So now you can see the price of Amazon stock on certain dates. You just have to move your mouse along this line until you find the date. For example, I'm going to choose November 15th, 2021. And on the right here, you can see the price of Amazon stock on that specific date, which is $183.83. Let's see another date. So I'm going to go right here to May 16th, 2022. And I can see that on that day, Amazon stock's price was $107.59. So basically, in this graph, you can see the price of the stock you are investigating, and you can analyze the tendency and if this stock has fallen or gone up recently, etc. For example, right here I can see that Amazon stock price has fallen over the past year because right here it's at $109.56 of price, and at the beginning of the year, or 1 year ago actually, it was at $175.55. Let's do a recap of what we have seen so far this video. Today, we have learned the stocks that have rapidly grown recently are usually more risky investments, and the stocks that have fallen rapidly recently are usually less risky. We have also learned that older companies that already have profits present less risky investments but usually have less potential for growth, and that developing companies that are just starting to grow are more risky investments but they have potentially better profits. Also, we learned how and where to read financial graphs. Well, it really depends. It depends on many factors like your age, your dependence on the money you're investing, the amount of money you're investing, and your financial goals. If, for example, you're investing very little money, which you wouldn't mind losing, and you want to try to make a lot of money with that capital, you should choose to invest in developing companies because they have the largest potential for growth, and risk is not much of a problem for you because you don't mind losing money. If, on the other hand, you are, for example, investing large amounts of money you will need for your tuition, you should probably choose to invest in more developed companies which have less chance of making you lose large amounts of money. If you are an older person and are planning on using money from your stocks for retirement, you should invest in stocks that grow slowly but have less risk. And if you're a young person investing money you don't mind losing, you could also take more risk. Of course, you always have to find a balance. You can choose a few developing companies and a few established companies for a balanced portfolio where you have a chance of making a lot of money, but are also not in danger of losing all of it. If you dislike the idea of having to constantly analyze different companies and wants to still have very good, reliable returns, you should buy the S&P 500 fund. This stock represents the price of the 500 largest companies in the US, like for example Amazon, Apple, Netflix, among others. If the 500 biggest companies all go up 10%, the S&P 500 fund also goes up 10%. But why do I recommend this investment choice? Well, the S&P 500 has had around a 10% average return over nearly the past 100 years. And only 26% of professional investors who pick individual stocks are able to beat this return rate. This shows how the S&P has great return rates, and it is also a very stable investment because it has grown constantly over the past 100 years. Also, since the S&P 500 follows the price of hundreds of companies, if one of these companies goes down in price drastically, the S&P 500 will not be affected too dramatically. This means that the S&P 500 is quite a safe investment. There are many S&P 500 funds you can buy from. Most of them work pretty much the same, so just choose the ones that take less than 1% of your money for managing the fund. For example, you can choose the Vanguard 500 Index Fund. What you're seeing right now is an investment calculator. Investment calculators are great tools for knowing what stocks you need to pick in order to achieve your goals. To set an example in this investment calculator, let's imagine that I need to buy a car when I turn 18. Let's imagine too that this car is going to cost $15,000. So right here we have to write the starting amount that we're going to invest with. I'm going to write $8,000. So let's imagine that I have this amount of money stored in a bank somewhere. Then I have to add an additional contribution. Let's say that my parents give me $100 as a monthly allowance. And let's write 3 years to grow because I'm 15. So by the time I am 18, 3 years will have passed from now. And then let's see what's the rate of return we need in order to reach my goal. So my goal is $15,000. Try with 6. 13, okay, it's getting closer, but it's not yet there. Let's try with 9. It's not quite $15,000. And if I write 10, that's pretty much $15,000. So with this investment calculator, I found out that with $8,000 of starting amount, $100 of monthly contribution, and 3 years to grow, I will need around a 10% return in order to reach my goal of $15,000 for my car. With this data, I can now know which type of stock I need to invest in. Personally, since I need a 10% return over the next few years in order to buy my car, I would invest all of my money into the S&P 500 fund. This is because this fund has shown a 10% average return rate over nearly the last 100 years. If you want the link of the investment calculator, it is in the description of this video. Before investing in a company, you should always do research to make sure that it will grow over time and will do so according to your needs. To investigate a company, look up their financial data on Yahoo Finance, the website that I am on right now. All companies listed in the stock market are required to show certain financial data. So let's look at some financial data that will help you determine whether a stock is a good choice for you. So right here where it says 1.115T is the market cap of a company, right? In this example, it's the market cap of the Amazon company. Market cap is the total value of a company's shares, and it is calculated by multiplying the price of a share times the amount of shares that the company has basically. So Amazon is composed of around 10 billion shares, and that times 109.56, which is the stock's price, should give this number right here, $1.115 trillion. Market cap is really useful for knowing how big and established a company is. Companies that have over $200 billion of market cap are usually very large companies that are already selling in many countries, and most of the time they already have profits and are pretty established companies. When companies have less than, let's say, $10 billion of market cap, they are usually smaller, more developing companies, etc. So basically, by seeing the market cap, you can see how big a company is. The more market cap, the bigger it is, and the smaller the market cap is, the smaller the company probably is regarding how many assets it has and how much profit it has, how big it is regarding the amount of places it sells its product, etc. Another thing you should search up about a company before buying its stock are its revenue and its earnings. So you can see this if you scroll a bit down on the Yahoo Finance website and you reach this graph right here. This graph shows the annual revenues of the company over the past 4 years. So if you hover your mouse right here over the green bar, which here it says it's the revenue, it shows that Amazon has had a revenue of $469.82 billion. The revenue is basically the total amount of money that a company has generated. The earnings, in contrast, are the profits that the company has generated. So the revenue minus things like taxes and cost of production, cost of employment, etc. So here we can see $469.82 billion of revenue and $33.36 of revenue. Here we can see from other years, and we can observe how Amazon has grown its revenue consistently as well as its earnings. Seeing the revenue and earnings of a company is really useful because seeing that a company has earnings is a sign of a less risky investment, because that company will probably not go bankrupt because it is generating money every year. And seeing the revenue lets you know how, once again, big a company is, because the more revenue they generate, the more large the company is considered. If you go all the way to the top and you go right here where it says forward dividend and yield, you can see how much money per share your company pays as a dividend per year. I changed the stock to Apple because Amazon does not pay a dividend. So right here we can see that Apple pays $0.92 per share that you buy. Another thing you can see in Yahoo Finance are the employees of the company. You can do this right here if you click Profile. Here you can see how many employees the company you're investigating has. We can see that Apple has 154,000 full-time employees, and you can see who the CEO and director, CFO, among other important positions in the company are. For example, we can see that the CEO and director of Apple is Mr. Timothy D. Cook. Another very important thing to look at while investigating a company is the company's balance sheet. You can find this balance sheet right here by clicking Financials and then clicking Balance Sheet. Well, what is a balance sheet? A balance sheet shows the total assets and the total liabilities of a company. Assets are the items that provide future economic benefit for a company, and liabilities are the things that a company owes to other people. So liabilities are basically things that take money out of a company. Some examples of assets include cash, investments, machinery, real estate, among other things, and some examples of liabilities are bank debt, taxes owed, wages owed, among other things. So right here we can see that Apple has around $351 billion of assets in 2021, and they have total liabilities of $287.912 billion in 2021. It is very important to know a company's assets and liabilities, because if they have a lot of liabilities and very little assets, this may mean that they will in the future not be able to pay their liabilities because they will owe a lot of money and not have enough assets to generate money to pay those debts. The next thing you can look at while investigating a company is the company's PE ratio, which is right here. PE stands for price to earnings, and the PE ratio basically measures the price of a share relative to the earnings per share of the company. Basically, the PE ratio indicates how the price of a company's stocks relates to the amount of earnings that the company generates. It's very important to look at a company's PE ratio because high PE ratios indicate that a stock may be overpriced. This is because if there is a high PE ratio, this means that the company might not have enough earnings to justify the high price of their stock. For example, a lot of people consider Tesla stock to be an overvalued stock because their PE ratio is 91.39. This means that their stock price is very elevated compared to the amount of money they earn. Of course, these are just a few of the hundreds of ways you can investigate a company, so make sure to do thorough research in a company before buying its stock. Well, that's all for today. I hope you enjoyed. Today, we reviewed how we can know which stocks to invest in. Stay tuned for tomorrow's video where I will explain how to manage your stocks after buying them. The name of tomorrow's video is this one.